Apple just released some news today, Sunday, that they are warning that iPhone 14 Pro shipments have been hit a snag in production in China. So one of their factories, I am not going to try to pronounce this name because I have no idea how to say it, but they have hit a little bit of a speed bump in terms of shipping out these iPhone Pro 14s or whatever they're called. Now, most likely, if you're watching this video, I wouldn't be surprised if Apple shares fall today, aka being Monday. Now, they recently reported their earnings and they actually did pretty well. Now, going back to their earnings, I'm just having up here on the Yahoo Finance, they beat their earnings pretty much in the Q4 2021. All the earnings they beat from Q4 2021 to Q1 to Q3 of 2022. They beat them by a few cents. They've done extremely well, and they're actually one of the big tech companies to actually have their stock price rally. As you know, Meta is not doing so well, Amazon's not doing so well, Google's not doing so well, and Apple is currently larger than all of those three companies combined. But as you know, folks, as you know, when news comes out, something gets snagged or whatnot, the common investor gets incredibly nervous and then starts selling off. So the time of recording this video, the stock price is 138.38. Now, I wouldn't be surprised, folks, if this stock price declines, as I said. But here's the thing with Apple. It's a solid business. You definitely know what this brand is all about. Their iPhone 14, I don't think people have been super happy with it. Essentially, just a reskinned iPhone 13. But listen, you are not buying Apple for the tech. The tech is great. It's good. But you're buying it for the brand, and they are loyal. They have loyal customers. Now, ranking this company a 7 out of 10. What does this number actually mean, folks? So this software here takes a look at the cash flow statements, the income statements, and the balance sheets of this business, grades it out of 10 based off of their 5-year performance. So with Apple, we are ranking this company a 7 out of 10, and they're doing a lot of things right. The things they are doing right are pretty important. One being they have a high ROE, so we want to see a number over 15%, and they're currently sitting at 110%. EPS growth is up by 515% over the last 5 years. They are buying back shares. Their net income is up. The free cash flow is up. The return on invested capital is extremely high, sitting at 38.94%. That's phenomenal. That means they make a phenomenal, great investment on their money that they have invested, as well as the revenue growth is up as well. The only places where Apple is losing points is in their PE ratio, sitting at 24.75, where we like to try to find companies in a more value territory. Let's say beneath 22.5, 22.5 is ideally what we want to find, because that is more of a fairer multiple. You can only justify, let's say, a company at a higher PE if they can justify that growth, if they can grow quickly. Apple being a $2.2 trillion company at this sizable market cap, it is hard to justify a higher PE ratio just because of, well, it can't really grow that much going forward. It's going to continue growing, but obviously at a slower pace. Current ratio is a little bit of a concern because it's 0.88. Now, a current ratio is something I like to look at is, and especially as we go into a recession, this is a lovely key point to take a look at, because this ranks how much assets the company has compared to the liabilities. So a 1-to-1 ratio would mean that they have enough equal assets to liabilities. We are looking for companies that have a current ratio of 1.5 or higher. Personally, this is what I like to look at, because that would indicate that they have enough assets on hand to cover their liabilities, plus some margin of safety left over in case things get a little bit hairy. Now, in the case of Apple, this might be a great scenario, because now you have your production slowing down, right? Now, that may hurt your revenue going forward, because now, let's say people want to buy this iPhone 14. Well, now production is being slowed down by a certain amount. We have no idea how much. Or the other factor, like I said, recession. Maybe people are not spending that much money. Maybe people are going to be fine with their iPhone, and they're going to say, hey, I don't want to spend money on another iPhone. Hence, a decrease in revenue. And listen, they have debt. They are in debt to people, so it all just trails off of that. The less debt you have, folks, the more you can survive. Now, with Apple, I'm not saying that they're going to go under, but a healthy current ratio helps. But that being said, their debt to equity ratio, pulling this up, 195%. They are extremely leveraged in debt. Not a good thing. Now, I understand why they're doing that, because borrowing money up until the last little while was cheap. Interest rates were low, so all these tech companies were just boring. And now look, they are knee high, actually probably neck high, rather, in all this debt here. And as we approach a recession, these are going to probably be the two major factors to see how hard they get hit. So this production slowdown, it might just be the tip of the iceberg. We don't know. But I won't be surprised, as I said, if the stock price falls. But other than that, they are a solid business. Warren Buffett loves this company. I think his portfolio is allocated 40% to this one company. Now, just to tie it back to the PE ratio, as I said, it's 24.75, but currently it's sitting at 22.23. And this section of the software here can just compare and contrast what those improvements or disadvantages are with the current company. And you can see the ROE is like insanely high. Like, my God, it's insanely high, and EPS is high as well. Like, this is the largest company in the S&P 500. This is like the American company. I have some numbers in here from before. I'm gonna click clear rather to clear those numbers out. This section here just finds the intrinsic value of any company you're looking at. If you want to get your hands on the software, folks, 7-day free trial. Follow the links down the description below at leodeleo.com. 7-day free trial if you like it. There's a coupon code called Founder, and it's for a limited time offer, 20% off your subscription for life. Loading up the free cash flow statements of Apple, let's go to an annual basis. So here's one thing I like to look at with every company when I investigate is, on an annual basis, how are we doing for free cash flow? And Apple is a cash king. Take a look at this. 2013, $44.59 billion in free cash flow. Currently, $111.44 billion in free cash flow. Compare that to their revenue, folks. So we go to the income statement. Let's go to an annual basis as well. Revenue, take a look at that. $170 billion in revenue. Boom. 394. So this company has just been increasing, just steadily going up and up and up in terms of revenue. So do I think Apple's a recession-proof company? Absolutely. There's no doubt in my mind. But here's a great opportunity, folks. As these people get nervous, they're going to sell off. I wouldn't be surprised if I see this company's stock price go lower, because that would be phenomenal. Just in the general panic of things. There's not much to say about Apple other than it's a phenomenal business. The only gripe that I have with this company when I analyzed it in the past is the price. Now, we obviously want to find companies that are undervalued, and Apple always trades at a premium because, well, it's Apple. It's the largest company in the S&P 500. It's a recognizable brand. It's probably one of the top brands in the tech space right now for, well, one, the status that you get when you own one of their products. Two, they actually make pretty decent products. I don't typically own any Apple products. To be honest with you, I just don't buy into the ecosystem. I have a position in Apple because everyone I talk to that has an Apple product, and I say, hey, why don't you switch to Android? And they say, oh God, no. I have the Apple Watch. I have the Apple phone. I have the AirPods, Apple TV, everything. They are loyal. That being said, and I will stop rambling, we're going to go take a look at the intrinsic value of Apple. I'm going to plug in some numbers over here. If you're new to the channel, I'll explain this in just a quick second. But we'll do a 10-year analysis, and we're going to find out what you should be paying for it if you had to go into invest into this company today. And folks, if you liked the video so far, hit that like button, hit the subscribe button. It means a lot to me. It means a lot to the channel. Now back to the price analysis section. The intrinsic value software here. Take a look at this. So a 10-year analysis. So I'm going to discount everything back, and we're going to figure out what we should be paying. So if you're new to the channel, I like to try to stay as conservative as possible. Those who have watched my videos time and time again have probably heard me say those lines so many times. I just have to, I feel like I'm repeating myself. But the important thing is, folks, to stay conservative, because if you stay conservative, you give yourself the most margin of safety. So revenue growth, I've done 4, 4.5, and 5%, because look, folks, it's a $2.2 trillion company. It'd be stupid and illogical to think that this company can grow 10% a year. They could, but it'd be very unlikely. Profit margin, free cash flow margin, I've stayed true to the numbers that they've given us. See, the historic numbers, that would make sense. I believe they can hit those numbers again. 25, 23, 22, cool, I'll stay within that realm. Price to free cash flow, PE ratio, I've done the magic 14, 16, and 18 combination. where I want to stay underneath a multiple of 20, because 20 to me is a fair multiple. As I mentioned earlier, if you're paying for a higher PE ratio, you are expecting a premium for a company that's a quick, fast-growing company. Apple's not that company. Apple is a slow-growing behemoth because it's, like I said, market cap plays a huge role into that. So it makes sense to go beneath the 20 realm. And honestly, 14 on the low end makes the most amount of sense of all the numbers I'm saying here. 18 at a $2.2 trillion company, it's really pushing it. But here, calculating all of this, current price is $138.38 at the time of recording this video. The average calculation comes down to be $91.28. So where do I think it is? It's somewhere in between here. It's $80 and $90. Call it $85, guys, on the safe side. Yeah, currently overvalued in my opinion. You might disagree with me because of my obviously revenue growth numbers, but you have to factor in. Look, as much as I joke around about how people drop off shares on this company because of the whole, let's say, production issue, if that ends up happening, I don't know, you tell me when this video comes out tomorrow. But the main thing is this. It's such a large company, you can't expect it to grow that much. And in this current economic climate where people are just throwing money at the stock market when everything just went up, and plus a lot of people have just been dumping money into, let's say, an index fund, which also owns a lot of shares of this company. People have just been passively investing into Apple, and obviously you have the people that have actively been investing into Apple. It's inflated the price just a little bit, but it'd be foolish to think that this company can grow as quickly as it once did, because that's simply not the case. And as we potentially approach a recession, you have to keep in mind, you know what? They're going to probably grow slower because people are not going to have as much disposable income to be spending on the latest iPhone or even justify their Apple TV subscription. These are just things that pop into my head. These are the things that just make sense. So if I can give myself the most margin of safety as possible, that's what I'm looking for to try to buy this company at a more reasonable price. $140, it's a little steep for my liking. And yeah, that's where I'm currently sitting on it. What do you think? I'd love to hear what you have to say about this. What do you think about this analysis? Write it down in the comment section below. And as well as, like I said, get the software here. You can analyze any company you like. We have everything available, and the software is currently in a desktop format right now, but we are diligently working to get it out to you on mobile platforms also. So like I said, we have income statements, we have the cash flow statements, we have the balance sheets, going back 10 years for the company, as well as we have charts. So we have everything visually in case you don't want to read any numbers. You can see everything from a nice visual perspective. See how it compares the free cash flow against the earnings per share, the shares outstanding, total assets versus liabilities, who actually owns this business, and its historic performance against SPY. There's more things along the way. This is a phenomenal piece of software that essentially pays for itself, folks. So here's the thing, folks. This software here, I'm giving it to you guys for dirt cheap, like literally 15 bucks a month Canadian, which is like nothing for you American folks. And you get all this access to software that people are charging you an arm and a leg for. But I wanted to make it accessible for you retail investors, because like this software has helped me a ton, but obviously it's not fair to just keep it for myself. So that's why I'm sharing it with you guys. Anyways, folks, check it out. Write down in the comment section below a company you want to see it evaluated. I will see you in the next video. Thank you so much for watching.